Hi, I'm Myssy, founder and director of Myssy Co, a professional services firm based in Sydney. There are many ways to save on tax. Setting up a suitable tax structure is one of them. So I'll be going through the 4 different options and what you need to know to choose the right one for your situation. Before I continue, however, please note that this video should not be seen as a reflection on our views of the current state of the property market and thoughts on whether to invest or not. We always recommend that you seek tailored professional guidance to ensure that it takes into account your personal circumstances, objectives, and needs. If you are a PAYG earner on a high income, you could invest in property as a sole owner. This ownership structure would allow you to maximize your tax benefit if you're negative gearing property, as rental losses are offset against individual tax rates, which could be as high as 47%. But all of your capital gains are isolated in your hands, so you can't distribute gains to other parties to leverage lower tax brackets when you sell. Another ownership structure you could consider is joint ownership. Joint ownership is when 2 or more parties can own an asset either equally or in a designated portion. This is beneficial from a tax perspective because you can split the profits and reduce your tax liabilities. You can leverage the fact that each owner falls under a different tax bracket. So whilst you may not maximize that income tax refund, you could save significantly on sale where capital gains are distributed more evenly. The third ownership structure that you might find makes sense in light of your financial circumstances is a trust structure. A trust is a legal relationship between a trustee and designated beneficiaries. Basically, the trustee is holding an asset on behalf of the beneficiaries. This is great because it offers a significant amount of asset protection, and there's a lot of flexibility in tax minimization strategies. For example, with discretionary trusts, trustees can distribute trust income to different beneficiaries based on their tax brackets. So you could utilize each individual's lower tax brackets. Unfortunately though, this doesn't necessarily apply to all trust structures. So you need to consider that in your decision. If a trust structure doesn't necessarily work for you, you could consider using a company as your chosen investment vehicle. A company is a legal entity that exists separately from its owners, but there are quite a few pitfalls you need to consider. For example, it's a less effective structure for negative gearing because companies can't distribute losses. You also won't qualify for the 50% capital gains tax discount if you sell the property after 12 months of owning it as an investor. Fortunately, your income is taxed at a capped tax rate. The last structure you should consider is a self-managed super fund or an SMSF. An SMSF is a type of regulated super fund which is privately managed by its members. It offers the lowest income tax rate out of all the structures. Ordinary income is taxed at 15% and capital gains are taxed at 10%. And once you reach retirement phase, you don't have to pay any tax at all. But SMSFs are highly regulated, which means you have to comply with extensive laws and strict guidelines. So, those are the different ownership structures you can consider. Here at Myssy Co, we look at property as part of a comprehensive tax planning and investment strategy, which we ensure aligns with the client's overall financial goals. I hope you have found this video helpful as a part of your journey to financial success. Thanks for watching.